Investment mistakes are not only for novice investors. Recent market volatility, uncertainty, and emotions have ensured that even the most seasoned investors experience a mishap or two in their career.
So what we currently see is that obviously equities have been under pressure for a prolonged period of time now, and this has really skewed the traditional risk-return dynamic in asset classes that investors would be accustomed to. So typically what you would see is cash is more on the conservative end, but the return is lower, then you would go up to bonds and credit and property, etc. Ending off with equities, which is uncertain, but the return prospects are much more attractive over the long term. But given now that equities have underperformed for a medium to longer term already, the question that we do see is that where are equities going? The economy doesn't look like it's going to recover anytime soon. Shouldn't we just invest everything in cash? So that's one part of what we see is more of a behavior thing. And on the other side, what we do see is given that these historic returns have now obviously filtered into some of the fund returns, historic fund returns, we do see some of the more conservative mandates outperforming some of the more assertive or aggressive ones. And that's now introducing a scenario where investors are migrating into these more conservative products because they're just not being compensated for taking the additional risk, at least not historically. So I think the right thing to ask yourself at this point though is to say, is the next 5 years going to be anything like the past 5 years? And that's why I think it's really a mistake, because unless it's exactly the same, investors shouldn't be using that data at the moment to make their investment allocations. Well, I think there's a threshold of sorts in tactical asset allocation. So tactical asset allocation typically refers to being more tactical around how you implement capital in a portfolio. So say for example, you've got a CPI plus 5 mandate, you acknowledge that you need at least 60% in equities to get to that return, you need some offshore exposure, you'll need some cash, etc. So you can backtest for sort of what type of portfolio you would need to get to that type of a return. And then tactically, given your outlook on markets, or whatever it may be, offshore, local, conservative, more aggressive, you can make tilts to your cash position, your equity position, your offshore position. What we typically see is that's maybe a 5 to 10% move in terms of upweighting your equities or downweighting your equities, depending on your view. But where the mistake is when that becomes too excessive, when it becomes emotional and excessive in the sense that maybe you cut your equities back from 60% to 0. And that becomes market timing, and that could be a crucial or a terminal mistake really in a portfolio. In the fund space, you don't typically see that, so fund managers I think are more experienced than that. But unfortunately what we do see is in the private client space is that there is a demand for de-risking portfolios much more aggressively, and the sense is just that the timing is most likely very off. Yeah, so diversification is a fundamental thing in a portfolio management system. So it's really, really important. It's obviously therefore for risk management. So if there's specific events that arise, then obviously you can do a lot of damage in a portfolio if you aren't sufficiently diversified. But I think in this specific case where investors have moved down the risk space or down the risk curve into more conservative cash type products, the key risk that you take is actually inflation risk, because the likelihood that your portfolio will after cost and after taxes exceed inflation becomes increasingly small. So that's why you need growth assets in your portfolio that can broadly track inflation. So I think the key risk that you're really taking there is the risk of not outperforming inflation. So it's a different way of thinking. Typically, we talk a lot about the risk associated with equities. Given the uncertainty, it's fairly obvious, it's easy to understand. But cash, to most people's surprise, also comes with its own set of risks, in that it's actually the asset class that offers you the highest risk of not beating inflation, which is a completely different way of looking at it. The highest risk of a financial plan's failure really occurs when you start to deviate on the journey and start to make significant changes. So for me, going back to the plan, making sure that the objectives that were specified at the beginning of formulating the plan are still relevant, and the optimal asset allocation mix that was devised in order to get to that goal, as long as those things are still intact, then you just stay the course on the plan. Because I think inherently to investments, as soon as something goes wrong, or not just investments for that matter, people feel they need to take action when things aren't going according to plan. But in the investment space, maybe that underperformance is actually still part of the plan. It was accounted for. So when we do projections on the 40-year returns of equities, for example, we already make provision for multiple corrections on the road, multiple stressful periods. There's a healthy appreciation for the cyclicality of both the economy and markets.
Well, there you have it. Some of the biggest mistakes in investing can be mitigated through understanding that the markets are often irrational, optimally positioning portfolios, and through diversification. For more information on this topic and a range of others, visit our website.